November 18th, People Not Titles podcast. Today we have the NAR Summit that has just completed, Matt, and they have come out with a fresh set of initiatives and economic forecasting and MLS news that will affect every single MLS in the country. Plus, we have Fannie, Freddie Mac, and new credit scoring models that could help homeowners get in the home sooner. We're coming right at you. People Not Titles podcast. Well, hello, this is Steve Kaempf with the People Not Titles podcast. I'm here with Matt Lombardi, our ever-beloved partner and cohort.
That might be saying a lot, beloved.
Yep. No, you are beloved, Matt. The fan, the groundswell of fan support for you is big.
The fan.
Yeah, you have a big fan.
That's funny.
Okay, Matt, today we have a lot of great news, and we're going to start off with Fannie and Freddie Mac and their new credit scoring models, which could kind of loosen up the market. So let's talk about that.
Yeah, and we talked about this, I don't know, a couple months
Vantage
ago.
Score.
The Vantage Score came to market, which was a new alternative, competitive credit score from the big three credit reporting agencies. So Experian, TransUnion, and Equifax, I think, is the third.
Yes.
But anyway, so the Federal Housing Finance Agency is reportedly, I like this, very close to a deal allowing Fannie Mae and Freddie Mac to accept what's known as FICO Score 10T, which is a more inclusive credit scoring model from Fair Isaac. And Fair Isaac, for those of you that don't know, have the monopoly of your credit score.
Yes.
So the credit score, what does it go to? 0 to
850 or whatever, yeah.
850. So Fair Isaac is the one that controls our credit scores. So this one, as we just said, this new FICO Score 10T is a new competitor to Vantage Score 4.0 that came to market. And so this FICO Score 10T includes what they're saying trended credit data and considers rent, utility, telecom payments, which...
This is it. Yeah, Matt, this is important. Number one, we knew that when Vantage Score came on, that FICO was going to have to respond because you got this new competitor that's going to be judging people in a different way. Plus, I think you have all these renters that are in the market that are now, we want to move them from renter to owning. And so why not consider their rent payments as part of the equation? Of course we should. If you're paying timely rent, it can be assumed for your domicile, you're going to be paying a timely mortgage payment.
And it's funny because I know in the younger generation, maybe you younger folks watching this, many of you probably don't even have credit cards. Mm-hmm. I mean, I know that there's a lot of 20-somethings that don't have credit cards.
Avoid
and that's
it.
Like the number one thing that is used for your credit rating.
Right.
So I like that they're at least talking about this. There is an alternative now with Vantage Score, this FICO Score 10T, which includes the things that I think the younger generations need to be considered for credit worthiness, which is rent, utility payments, and their phone.
Right. It always seemed counterintuitive, I think, to a lot of folks, is the more debt I have, my credit score goes up. So the less I can afford things, the more I can borrow. Or I pay off my credit card and something funky happens and now my credit score goes down because I am being responsible. So I think this is good, Matt. And it does say that these models could expand mortgage eligibility to millions of additional borrowers. And my thought is, if they're unfairly being judged and they can't qualify to be in the buyer pool, this is a great thing.
Right. And so for you agents out there working with younger clients who are worried about their credit rating, credit worthiness, at some point in time, hopefully it'll loosen the reins and restrictions that they may be experiencing to get the financing that they would ultimately need to purchase their property.
Absolutely.
So that's a good thing. What other things we want to talk about here? Before the rollout, Fannie and Freddie must issue loan level price adjustments, which could take until mid to late next year.
Okay.
So that's the problem. They're talking about it. It needs to move a little quicker.
Yeah, Matt, and these loan level price adjustments are basically that they're going to build into the pricing the risk that's associated with the new model. And this will probably be determined over time how accurate these models are. So if you have a higher risk profile, there's going to be a higher price, but there will be a way for you to get the mortgage.
Yep. And so I think we could sum this up, Steve, that this is a new alternative on the marketplace, different from the original FICO scores that we have been judged on for years. So coming soon to a mortgagee to you will be the secondary FICO score.
Yeah, Matt, and I think a key thing is going back to the Big Short, which people might be getting PTSD on here, thinking, oh, are they going to have a different pool of borrowers getting into there that actually shouldn't qualify for mortgage? I think we can look at this as there's a different rating scale that is more coming in line with what does a responsible borrower look like now. Matt, let's shift. Zillow versus Compass.
I know, I feel like we've said this, I don't know, every other week. It's a Zillow Compass Zillow thing.
But it's not the same old thing, Matt, here.
No,
this is new stuff.
Yeah, this isn't a lawsuit. This is more of, how would I say it, a thorn in the side of Compass. So the headline that we'll say is Zillow reignites feud with Compass, where Zillow created a survey and sent it to all the Anywhere real estate agents. And this was done ahead of the approved merger that we've talked about. So Compass, big news, bought out and is wanting to buy out and merge with Anywhere Real Estate that has the legacy brands Coldwell Banker, Century 21, Better Homes and Gardens, ERA. Huge brand structure. Zillow, just to be a pain in the butt to Compass, said, we're going to survey all the Anywhere agents and let's get how they feel about this coming up. So that's what this is, and we're going to talk about.
Yeah, Matt, and we reported last week's podcast that the Refkin came out with the big news saying, hey, Anywhere agents, if you like your brand, you can keep your brand. You don't have to do it the Compass way and all that. And I think that what they were trying to do is get ahead of these statistics here, which why don't you share them, please?
So some of the survey results include 18% of Anywhere agents said they would definitely leave if this Compass deal closes. Another 35% said they might consider leaving. And then 23% believe that the merger would have a negative impact on their business. Okay, so you agents out there that are part of the legacy Anywhere brands, as Steve and I continually say, you are your own brand. You can pick and choose wherever you wish to work brokerage-wise or for yourself in your own brokerage. Pick the company that is going to work best for you and most importantly for your clients, whether that be Compass, Anywhere brands, or something else.
Matt, I thought it was interesting. This is a caveat because we think, oh my gosh, they talked to thousands of agents. It says Zillow says it surveyed thousands and verified 122 responses.
So I actually have a note on this as well. Having managed many marketing research projects over the years, so it sounds small. It could be, and I didn't find it, that is statistically significant, meaning that it is valid, because that's how these surveys are done. They send out 1,000, and if you get 100 responses, it is valid.
And you make a story.
So anyway, this is a good story nonetheless, and I think it does some of the highlights I think hold
Matt,
true.
Yeah, we know enough of the market to understand that if you're with one of those legacy brands, the reason you're not with Compass is because you didn't want to be.
Correct.
You know?
And so another point of the survey that we'll highlight here is the transparency and listings. And so Zillow asked in this questionnaire and survey, what do you think about private listings? And 70% of Anywhere agents said private listing networks are not in the seller's best interest. And I think if you surveyed all the real estate professionals out there, you would get 60 to 70% that would say the same thing.
Yes.
So
I think we even talked about the clear cooperation that 90+% of agents are in favor of clear cooperation, which is pull back the curtains and don't just put it on your secret squirrel network.
So what makes this whole survey thing even more fun is that Zillow and Compass are embroiled in two separate lawsuits. First one being their Zillow's listing access standards with Compass, which limits visibilities for listings. And then Compass sued Zillow in June, claiming they were abusing their monopoly power. We've talked about those. So it's just, like I said, a thorn in the side.
Matt, we reported last week that Zillow had their hands in 80% of the real estate transactions. And I think what Compass wants to be careful of is not to be locked out of that arm that's involved in 80% of the transactions, because they could be on the outside looking in this case.
Yep.
What's Anywhere's response to this, Matt?
They will not be baited.
Ooh.
That's their response. Then they highlight record agent retention and strong recruiting results in the third quarter of this year. And the company emphasized positive agent sentiment and Compass's promise to preserve the brand independence and agent choice in the Anywhere brands.
Matt,
so as you said, Refkin came out in an op-ed a week or so ago saying, hey, you Anywhere agents and brokerages, we're not going to do anything.
Right.
Which I don't think is the case.
No, and Matt, but this will be all remain to be seen because the transaction isn't supposed to go through Department of Justice, Monopoly, all these various, investigations and forensics. They're going to find out, and it won't close till the end of 2026, right?
Correct.
Okay.
And so this is just an ongoing battle, I would say, between Zillow and Compass, Compass and Zillow. But I think it is an interesting point of what Anywhere agents are thinking. And once this does go through, we'll see what the fallout is.
Mm-hmm. Matt, and I think Compass, in putting a capstone on this, I think Compass's philosophy of private listings, how they went all in with their strategy, it's eventually these stats will come out. Are sellers being hurt or are they being helped by their strategies? And if not, they're going to be smart to toggle.
Yep.
Okay, Matt, Fed director announces retirement.
And this is just more of an FYI piece where Steve and I report about the Fed, Jerome Powell, the board of directors, Fed directors. So, President Trump and his administration has been on these guys from day one. And so I think changes are coming. So Raphael Bostic, who is the president of the Fed of Atlanta, announced his retirement, which will take place officially in February of 2026. He had led the Atlanta Fed since 2017, and he said, I'm out. And so
He's getting while the getting's good, Matt.
He's getting while the getting's good. I think there's some things in the background that may have pushed him out. But our main point is more changes will be coming to the Fed governors, which means changes may be more quick to happen if the current administration gets their people, quote unquote, on the Fed.
And Matt, Powell is set for
I think it's May of next year as his term ends. So changes at the Fed, and we'll see what's happening.
Yep. Okay, Matt, there's a lot of talk. We talked last week about the 50-year mortgage. This week, we're talking about the Porta mortgage, like Porta Potty, except for this is Porta mortgage. Tell us about this.
So portable mortgages, and I'll ask you some stuff afterwards because you're a mortgage guy.
Yes, I'm a brilliant mortgage guy, Matt.
So the administration came out 2 weeks ago with, hey, maybe we could throw out 50-year mortgages, which Steve and I addressed in our last episode. If it happens or not, it's an alternative. It may not be the best for everybody, but it is creating more affordability, at least up front for people, whether
Might be a psychological factor, Matt.
So anyway,
people get involved.
If 50-year mortgages come to market for you people on the market for mortgages, work with your mortgage professional to see what works out best for you. Yep. Maybe it's a 30, maybe it's a 50, maybe it's a 10 or a 15. Anyway, so this week the administration came out and said, maybe we could do some portable mortgages, which I got to be honest with you, I wasn't completely familiar with, but I like the concept because portability sounds good.
People are locked in, Matt.
Right. So what is a portable mortgage? A mortgage that lets you sell your current home, and I think this is the best part, keep your existing mortgage. Crazy. And this includes the interest rate that you have. So for those of you out there with the 3 to 3.5% interest rates, you get portability in your mortgage. You sell your home and buy a new place. That mortgage rate travels with you, which I think would be phenomenal.
Matt, we were surprised to hear that this is very common. Well, I know I've heard of it in Canada. It's common in the UK. Not available here.
Not yet.
Not yet. And I think one of the differentiating factors with Canada and UK is that most of these mortgages are shorter term, 2 to 5 years.
Yeah.
They're not these long spreads where people are committing to interest rates for long swaths of time.
Yeah, I didn't realize that in the UK and Canada that they were such short-term loans, which is a good or bad thing depending on how you look into it, which is you have this short-term loan, you could be paying a higher interest rate, but at the end of it, 3 to 5 years, you refinance or you're out.
Or you renew.
So it's an interesting concept. And so, Steve, why portable mortgages don't exist in the U.S.? So, couple points. U.S. mortgages are tied to mortgage-backed securities.
Watch The Big Short if you want to know what that is, Matt.
That's right. And each mortgage is attached to a specific property in the mortgage-backed securities pool. Once again, watch The Big Short if you want more on that. And when a U.S. home is sold, the loan must be paid off, making portability structurally incomparable.
Yeah, Matt, so this is a whole structure where your mortgage is attached to the property. And one of the keys to safe lending and one of the reasons for The Big Short is that we had terrible appraisal processes where homes were overinflated, bloated, lots of different, you had appraisers appraising properties independent from mortgage companies. That's all been tightened up, so I don't believe we will experience that again. And so that is what makes mortgage-backed securities so much of a safer bet than it was back then, is because the appraisal process is good and you don't have these people with mortgages on properties that aren't even worth what the balance is.
Yep.
Okay, could portable mortgages come to the U.S., Matt?
Possibly.
Okay.
So policymakers, the administration are looking at this as a way to unlock our habitually frozen housing market by letting owners keep low rates. Maine explored this idea in early 2025, and the proposal failed because states can't rewrite the mortgage system. And so we said the current administration is now evaluating portability. We also talked about how they're also looking at 50-year mortgages and potentially expanding assumable mortgages, which we talked about on a past podcast episode. So there's obviously challenges associated with this. Our current market system is set up in a certain way with mortgage-backed securities, so that would need to be flipped. Homeowners would need, I think the mindset of homeowners would need to change on this, and it would require bipartisan support and some major restructuring.
Yeah, Matt, and very rarely is it that when you sell a home and buy the next home that you're taking out the exact dollar amount of the new mortgage. So there's a difference there. And so there's also a conversation about a blended rate where you take the smaller piece of your balance. If you owe $200,000 on your home now, but you need to borrow $400,000 for the future, that you have 200 plus 200 and get a blended rate. So that all sounds good, Matt, in boardrooms and on podcasts, but to actually make it happen and shoehorn it into the mortgage system today, my bet is this is going to be more of a talking point and less of a reality. We do have assumable mortgages today, Matt. I don't see it happening very often, but there is the idea that you can come into a property that has a low interest rate and assume the mortgage. FHA, VA, and USDA loans are assumable. So if you're making an offer on a home, that might be a play that you make.
All right.
Then you also have bridge loans, Matt, and you have rate buydowns. Not many people are buying bridges today. And in terms of a rate buydown, that's always been in the market. Matt, we have big news in that we've talked about the NAR ad nauseum. They had lots of legal haranguements in 2024. The market looked like they failed in that. Or they looked at it as they failed, and they did in terms of winning the lawsuits. Cost brokers a lot of money. They pulled these brokers in to have a conversation that says, hey, listen, what can we do to change? They brought in Nikia Wright. We talked about all the leadership changes. Now, finally, the smoke has puffed out of the chimney of the Vatican of the NAR.
I like that.
And they have a plan going forward that appears on its face, Matt, excuse me, to be intelligent, well thought out, and hits the mark. Let's talk about the highlights.
So if you'll allow me before we hit. So NAR has an annual meeting each year. If you ask 10 realtors out there, they'll call it the NAR meeting. What they now call it is NAR NXT. They made it fancy.
Okay.
It's essentially their business meetings, trade expo, and other stuff speakers. They had Gabby Douglas.
People Not Titles podcast is brought to you by Land Trust Title Services, your partners for results.
They had Gabby Douglas as a speaker. They had Robert Herjavec from Shark Tank as a keynote speaker.
Fabio.
No Fabio this year. He might be a little,
Fabio has been at these events, and Matt has a picture with Fabio. We might get that, Matt, next time.
We may have to put that up there, but yes, that's from many, that's 20-something years ago. Anyway.
Yes.
So this year's meeting was in Houston, and I used to get great attendance, 20, 25, 30,000. I think they maybe had 12,000 for this.
Okay.
Houston, maybe not the best draw. So anyway, this is their big annual meeting where all the big wigs, muckety-mucks, their business meetings are taking place, their governance meetings are taking place. So the whole leadership, the board of directors, executive team, everybody's there. And so what comes out of this is a variety of things. And that's where this 3-year strategic plan was announced,
And unveiled.
and approved.
Approved.
And unveiled. So this is what is coming out of NAR.
Okay,
So
let's hear it, Matt. Let's hit the highlights.
So this launches January 1 of 2026. It covers 24 initiatives, 8 commitment areas, and 75 projects. Some of these are apparently underway. Core goals include modernization, transparency, accountability, and improved member value. And what I will say to that is, good.
Yes.
These are the things that were pain points for the last many years,
Yes.
but really came to a head when the lawsuits hit. So number 1, zero-based budgeting, which I think is good. So number 1, every expense must be justified from scratch, no automatic carryovers. The budget, so this is a big thing. Next year's 2026 NAR budget is based on 1.2 million members. They are currently at over 1.5 million. So they are anticipating and budgeting for 300,000 less members on paper. Now, there's 2 ways to look at this. One is they look into their crystal ball and say, we're going to lose about 300,000 members, or they're looking in their crystal ball and say, we don't think we're going to lose that many and we're going to come out in the black
Yes.
because we're budgeting for this.
Either way, Matt, it's a smart move, I would think.
Exactly.
And Ikea Wright says she wants to understand the budget at the molecular level.
That's a good term.
You know,
I like that.
Expected to cut unnecessary spending. That's good. And will take time due to coordination with state and local associations to get all of these cuts kind of set in.
Yep.
And I think it's a great move, Matt, to get rid of the frivolous spending. There's been a lot in the media about this. They had to make a move on the money. Otherwise, people will say, what am I paying for except for a bunch of nonsense?
If you want some good insights, it's probably about 1.5 years ago, New York Times did a great cover story on the frivolous expenses of NAR with Broadway tickets
Yes.
and limos and dog grooming and
Yes.
other stuff.
Okay.
So anyway, there's a push for transparency. NAR is set to publish its first annual public progress report in the first quarter of 2026. I don't know what that is, but I can't wait to read it. Quarterly updates go to the executive committee. Member-facing reporting channels are still to be built. Okay.
Actionable intelligence for members, Matt. We talked about that there was a leverage of AI for reporting tools, more localized predictive economic analysis from Lawrence. We are a fan of Lawrence Yun, Matt. And more actionable residential and commercial research that's actually going to help its constituency.
Yep. And so there was apparently massive industry input for what went into this. This plan was shaped by, I like this, 150,000 plus voices
So almost
across
10%
the country.
of their constituency, Matt.
Yep. And Broker Summit participation represented about 700,000 plus members. So that's good. And so there's 6 signature projects, which we'll talk about briefly. Upgrade real-time market insights. 2, new legal leadership forum. Governance overhaul to reduce overlap and clarify committee roles. Full budgeting transformation with new guardrails. Better alignment between national, state, and local associations. Elevating overall realtor brand value. So those are all good things. Here are some commitments that are coming out of here. There's 4 of them. 4 members, better tools, training, tech, insight, and faster operational support for the industry. Stronger legal protections. They kind of missed the boat on that.
Something they need to have, Matt.
Improved code of ethics enforcement. Next-gen realtor engagement. No offense, they've been talking about younger realtors. I used to be a younger person. Now I'm on the back end of it. You missed the boat, and it's tough to get the younger realtors engaged. Anyway, number 3, partners. Commitments to partners. Improve collaboration, data sharing, and a clearer role with defined and definitions. Number 4, consumers, advocacy for expanded home ownership and stronger trust in the realtor brand. So those are the commitments that are coming out from NAR. And so here's some closing thoughts. NAR leadership says, NAR is in a race to prove its worth, focused on rebuilding trust and delivering measurable, valuable input value to members. We talked about so here's a big point. Dues, annual membership dues, are going to remain the same as they were this year, which is $156. I think there was rumors and talks that they're going to jack up dues to pay for their payments for the commission settlement, but apparently dues are going to be kept the same, which is good for you realtors out there.
They might be tapping into that side slush fund that they had accumulated, Matt.
Correct. As we talked about, they're budgeting for 1.2 million members, which is, about 300,000 less than where they're at today. And their political advocacy, which if you didn't know, I will reiterate, they are number 1, number 2 each and every year with their political advocacy expenditures. Zeke Morris is this year's RPAC chair. Zeke is a good guy. He's a local realtor here in Chicago. At the end of October, they had almost $39 million raised last year, which is 86% of their $45.5 million goal.
Matt, and I must say, just in looking at all this, kudos to Ikea, right? Who knows if they're going to be able to deliver on any of this, but I will say, kind of a little bit of a master class on getting your arms around things, clearing out leadership, creating budgets and transparency in finance, creating the value proposition, those kind of things. For any business that is under the public eye, these are great steps to take, and I applaud them for it, Matt.
Yeah, I like that. It's the proper, how she has managed the situation is a masterclass.
Yes.
So I also give her credit and kudos for addressing the issues that I think
they had to be addressed.
Right. It's not like people did not know what the issues were within NAR and their structure.
Right.
She addressed them. She hired the right people and is moving forward. So like you said, we'll see what happens. Nothing could come out of this, or major things could come out of it, but interesting.
Yeah, great. I would just say, Matt, great messaging, great communication, very clear, attractive. I think if someone says, I'm going to give you a second, some people might be beyond the second chance because they have second, third, fourth, and fifth. But for me, looking at this, and from Ikea being the new leader, I would say well done, Matt.
Yep. So you want to talk about the next big thing that came out of
What's
this
the next
NAR
big
meeting?
thing, Matt?
So to me, this is the bigger news. I mean, all that NAR stuff, that's fine. This is the bigger news, which is NAR changes their MLS policy. And this is what you all need to know, because this stuff is big.
Yes.
So NAR, due to their force and ownership of many of the MLSs, has taken the lead for years and years on MLS policy. What came out of these meetings in Houston is they're putting more pressure, I would say more pressure, but saying we're going to step away from our oversight of managing a lot of these issues with the MLSs. You local people are going to do it. So that's the big thing, is NAR completed a major antitrust risk review of all their MLS policies, and it resulted in repealing 18 policies from the MLS handbook. You've never seen it? I have. The MLS handbook is a book that says here are all the policies and procedures that you MLS executives and people on the MLS have to follow. These are our rules and regulations for everybody. Doesn't matter if you're in Seattle, Chicago, San Francisco, or Orlando, Florida. These are the rules for everybody. So the goal is to reduce national antitrust exposure and align rules with today's industry practices, and the outcome, major power shift from NAR to the local MLSs.
So, Matt, I think it's smart for them to let go of things that the local people say they can do better. The question is, can they do it better? Will they do it better? Will they have the muster? It's kind of like the dog that caught the car. Now what are you going to do?
Right.
And so these local MLSs have caught the car, and now we, and on the local level, and I think many people, particular Chicago, this is what they've been dreaming about, hoping for, and they're going to be doing it, Matt.
So the first point here is local MLSs are going to get and take more control and decentralize it from NAR. So national rules on private listings, non-member access, service areas, training, orientations, open listings, and IDX permissions are being rolled back. Local MLSs now have broader authority to set their own rules, fees, access requirements, and enforcement processes. Brokers operating in multiple markets should expect greater regional variation. So we had talked about this, that the biggest changes that are going to come out of these lawsuits and multiple areas of the country is MLSs are going to change. Who gets access to it? How are the membership requirements?
What are the fees?
Right. Do you need to be a realtor to have access to the MLS? I think that's what these main policies, peeling back, it's like, you here in the local area, you figure it out.
Yeah, Matt, and I think Chicago's a nuanced market. We talk about, a lot of our news is nationwide, but Chicago and many other markets are nuanced. And I think it's really important for them to have the power of it, and hopefully it can be crafted in a way that supports the market and their needs.
Yep. So why did this change? And the biggest thing is antitrust, the risk of antitrust. And many existing policies were outdated, ambiguous, inconsistently enforced, or vulnerable in litigation. Slimmer national policy equals less national liability.
Someone does something in Seattle they don't like, there's a lawsuit, next thing you know, it's all across the country.
Yep.
Copycats.
And so who gets access? So MLSs can independently decide whether to, 1, accept open listings, 2, allow non-member brokers and non-realtor licensees to participate and access their MLS, and 3, transmit listings to aggregators or run public-facing portals themselves. Training and onboarding, there's no more national requirements. So I think this is another big thing. National orientation and training rules are repealed. Local MLSs must design their own onboarding, education standards, and mandatory training hours, and MLSs are expected to look to CMLS, which is the association that runs MLSs. It's like their NAR. So they're expected to look to CMLS, State Association, and vendors for best practices.
Matt, there's an enforcement overhaul too now. Entire national MLS disciplinary guidelines section has been removed. The cap has been gone on the $15,000 fine. They're going to each MLS is going to set their own fine amounts, disciplinary things, and definitions of even misconduct, and brokerages working across regions should anticipate different enforcement cultures. Some will be, maybe there's some that it's just been the inmates have been running the asylum. Now they're going to have to tighten things up, and there might be a new sheriff in town, and others might get substantially looser and more liberal in their enforcement of this.
So what this means for brokers is MLS experience may be more widely varied market to market. Predictability and uniformity are giving way to local control and local scrutiny. And as one member put it, if local MLSs want control, they now have it. But with that comes more responsibility and scrutiny. So essentially, NAR has pushed the burden onto the local MLSs to reduce their liabilities from antitrust
Matt,
cases.
It's one. So 2 comments I have on this. One thing, it's one thing to bitch and moan about the process and all the things. Now it's placed in your hands and time for local leaders to step up. The second thing is, this may not be as much the NAR pushing it away and letting go as it is it being taken from them and them saying, okay, before it's an embarrassing thing where we have this fractured market, we're going to just give it to them and still try to keep some semblance of control here. Matt, let's get into the NAR's market outlook. This is what people are looking for. What are they thinking is going to happen to the market? What about mortgage rates? And what do they see the Fed doing?
So, as Steve says, we're fans of NAR's research. Lawrence Yun, Jessica Lautz, they're chief economists. They're obviously going to be more pro than con.
They didn't get fired, Matt.
They did not get fired. That is correct. They have kept their jobs and continue to do good work. So one of the big keynotes that comes out of these NAR meetings is, what does Lawrence have to say? So when Lawrence speaks, it's like when Jerome Powell speaks. They move markets. Anyway, so Lawrence Yun says 2026 could finally deliver a home sales rebound after these 3 sluggish years. Existing home sales, could jump 14% next year, but only if mortgage rates keep ticking down.
Okay.
So I like that. I've said this before. I missed my mark in my career decision. I should have been an economist or a meteorologist, where I could be 50% right or wrong and
still keep your job.
Absolutely. He predicts new home sales are going to rebound next year after a slight decline. Home prices are projected to rise about 3% the rest of this year and another 4% in 2026.
Okay, Matt, so we have a decent growth, and he's predicting a big jump in the market. Let's talk about mortgage rate expectations. Where do they see that going?
So they are expecting mortgage rates on average for 2026 to hover around 6%. And I would agree with that. I actually predict maybe a little lower based on the changes coming up with the Fed and continued pressure from above. But I think 6% is a safe amount that they will predict for 30-year fixed mortgages. And they're saying, rates are currently around 6.2, 6.3%. Inflation is still persistent at around 3%, which, when the Fed is looking at things, that's why mortgage rates haven't moved as much. And there's still that weak job growth and data gaps from our recent, pause in reporting.
Yes.
So I think once we get better data, we'll have a better understanding. But I still feel the economy is resilient.
Yes.
The job market has been resilient. The U.S. economy has been pretty good. And with the holidays coming up, I'm eager to see what consumer spending is going to be.
Matt, Fed Reserve and economic signals, what are they saying about the Fed?
So the Fed is cutting rates to avoid a recession with another rate cut anticipated in December, even though Jerome Powell said it's not a foregone conclusion. I'm hoping, and I think we're hoping, that there is another rate cut. You forecast 2 additional rate cuts in 2026. I mean, that's a safe bet. Mortgage rate drops are likely to continue, but not dramatically. And I would say that is correct, and that's due to government debt. Government debt is still way too high.
Yes.
I don't know if you follow.
Got to bring that down, Matt.
The Treasury, the government debt is way too high. And then he talks about moving, which we've talked about a little bit last week, the shifts in homeowners and home buyer demographics. First-time buyers, median age is 40 years old. Funny anecdote I heard is on their profile of home buyers and sellers, they had a nice young couple. They had to scrap it.
Oh.
Because it did not represent the 40-year-old first-time buyer.
They had more of the picture of the farmer and his wife type of thing?
Absolutely.
Okay.
Absolutely. Fewer buyers have children as more single adults and child-free homes people enter the market. That's raising the age of first-time buyers. I like this, the grandbaby effect. People are staying in their homes longer, which is now up to 11 years. It used to be about 7 years. And the repeat buyer, 62 years old.
Man, I did like this. People want to move closer to family, closer to their grandchildren, so they're thinking less about weather, less about vacation, more about cross-generational mentoring and all that kind of thing. I resonate with that. Matt, what are the cash and down payment trends that we're seeing right now?
So cash purchases continue to be at record highs, including 8% of first-time buyers paying all cash.
Wow.
I know. And down payments are increasing. Older first-time buyers are drawing from financial assets more than the traditional bank. I like this, the bank of mom and dad. So,
Matt, I love it. So what that means is this younger generation is coming into home ownership, it seems like, financially healthier than just trying to squeeze into a home with a minimum down payment. Not saying we can argue one way or another. We have a bunch of times,
and I think
kudos to them.
2026, there's so many things being talked about, thrown out there, that I think things will be on a positive upswing.
Yes. Okay, great. Matt, okay, let's put all this aside. The biggest news of our podcast is the Bears. I don't know since when, Matt, the first time in a long time, we can say, I forgot my phone number one finger, we're in first place.
First place.
Yeah.
Bears fans.
Sole ownership of it, Matt.
Who would have thunk it?
Yeah.
And I forget, someone called me out.
I would have thunk it,
Someone
Matt.
called me out on it, said it's on your podcast where you predicted the victories.
Yes.
And I think I said 7 or 8.
Yes. So we're here, Matt.
We're here.
So, hey, we squeaked it out. A lot of close games, Matt. That's a sign of a good team. So congratulations to the Bears. Matt, we have the big Mastery Cash Flow Conference this weekend. Go to andrewholmes.com, chicagorea.org to get your tickets for the Cash Flow Conference. We talked about 30% of the market almost are investors. And in Chicagoland, these are mom and pop investors, people just like you, saying, what's this investment community about? How do I get involved in it? And I always say, Matt, if you're with 5 people who are in debt up to their eyeballs, you're bound to be the 6th.
Yep.
And if you're around 5 real estate investors, you're more than likely going to be the 6th. So get around that crowd of people that are doing things that can build generational wealth.
And it's this Friday, Saturday, and Sunday.
In Oak Brook.
In Oak Brook. And I think it's cashflowconference.com. And if you use the promo code LANDTRUST, you get a little break on your admission fee.
I like that.
So yeah, check it out. It's a great program. And as Steve said, for the smaller investors who are really the assets driving the real estate market, 1 in 5 homes are sold, properties are being sold to smaller investors. This conference really addresses all that.
And the People Not Titles podcast celebrities will be making appearances
there. Will be many,
oh my gosh.
That's right, many celebrity sightings.
Meet the stars of the podcast, Matt. And finally, we have a CX meetings today. Customer experience is important to Land Trust. So talk just a minute about that.
So Land Trust is a different type of title company because we really leverage the customer experience side of what we do each and every day. So Land Trust and our team is dedicated to you, our clients, whether you be home buyers, sellers, attorneys, realtors. We are there going above and beyond. We ask you after each closing how everything went. And if things did not go correctly, we adjust and self-correct. So anyway, today we have our entire title team, almost 100 strong, coming into our office, where a couple of us are presenting CX principles, strategies, and how we could continue to get better. So thank you for talking about that, Steve.
You're welcome, Matt.
And I guess this is it.
Yeah, that concludes the People Not Titles podcast for this week, November 18th. We'll see you next week.
Thank you.
Hey, thanks for listening to the People Not Titles podcast. We are proudly sponsored by Land Trust Title Services. If you enjoyed the podcast, please hit the like button. Please subscribe. And we'd love it if you'd share our podcast with your friends. Thanks a lot.